The grain loan. The earliest loan documents are not paper. They are clay tablets pressed into existence in ancient Sumer roughly 5,000 years ago. Temples held grain reserves and lent to farmers before each harvest at interest. Hammurabi's code, written in 7092 years before Christ, standardized the rate 20% annually for silver loans, up to 33% for grain. Borrowers who could not repay surrendered their labor, then their family's labor, then their freedom. A debtor who became the legal property of a creditor was called a nexum, a Latin word meaning bound. Hammurabi canceled debts 4 times during his reign using a practice called misharum, meaning release. He understood that a credit system with no floor produced dispossession severe enough to threaten social order. That understanding appears in the Hebrew Jubilee, in Greek law, and in Roman legislation. It is still debated in Washington. The Bill of Exchange. By the 12th century, European merchants had a problem. Moving gold across the continent meant armed guards, mountain passes, and bandits. A Genoese merchant who needed to pay a partner in Bruges had no safe way to get the money there. The Bill of Exchange solved this. Merchant A deposited gold with a banker in Genoa and received a written order directing a partner bank in Bruges to pay the equivalent to a designated recipient. No gold moved, the debt moved instead, carried in a letter. The earliest surviving bill of exchange dates to 1256. Within a century, Italian banking houses, the Bardi, the Peruzzi, and the Medici, operated networks across Europe that transferred value through paper promises without moving a single coin. This was the invention of credit at a distance. It is the principle underlying every international wire transfer, every letter of credit, and every cross-border payment made today. Pawnbroking. The structure is ancient and unchanged. You bring an object of value to a lender. The lender gives you cash, typically 30 to 50% of what the object is worth. You have a fixed period, usually 1 to 4 months, to repay the loan with interest. If you do not repay, the lender sells the object. No credit check, no income verification. The collateral speaks for itself. Archaeological evidence of pawnbroking exists in ancient China and Rome. The 3 golden balls displayed outside pawn shops derive from the coat of arms of the Medici family, who operated lending houses across Renaissance Florence. In 1462, Franciscan friars in Perugia established the Monti di Pieta, which were public charitable pawn offices designed to offer the poor an alternative to private moneylenders charging higher rates. The charitable version spread across Italy and into Spain and France. The commercial version survived alongside it. American pawnbrokers hold roughly $6 billion in outstanding loans today, almost all of it from borrowers with no other access to credit. Islamic Finance. The Quran prohibits riba, a word meaning excess or increase, which Islamic scholars have consistently interpreted to include interest on money. The prohibition is absolute in principle and has been tested for 1,400 years. What Islamic jurisprudence developed in response is an alternative architecture. In a murabaha, which is a cost plus sale, the bank buys an asset you want and sells it to you at a markup with deferred payment. In a mudaraba, which is a profit-sharing partnership, the bank provides capital and the borrower provides labor or expertise, and profits are split by agreement. In ijara, the bank leases an asset to the borrower and transfers ownership at the end. Sukuk are Islamic bonds structured as ownership stakes in an underlying asset rather than as interest-bearing debt. These instruments allow economic functions nearly identical to conventional lending while avoiding explicit interest. Whether they are genuinely distinct or simply rebranded is a debate among Islamic scholars that remains unresolved. Modern Islamic banking holds over $3 trillion in global assets and operates in every major financial center. The government bond. Venice issued the first sovereign bonds in the 1200s, calling them prestiti and paying 5% annual interest to investors who lent the city money to finance wars. England issued bonds to build its empire. France issued them to fund its royal court until it couldn't, and the resulting fiscal crisis contributed to the Revolution of 1789. The United States issued war bonds in both world wars, selling them through post offices and payroll deductions, and framing the purchase as a citizen's duty. The government bond is the mechanism by which a state borrows from its own population and from foreign investors, promising to repay with interest at a future date. Today, the U.S. Treasury market holds roughly $30 trillion in outstanding debt, making it the largest bond market in the world. The interest rate on the 10-year Treasury bond is the baseline against which almost every other credit instrument on Earth is priced. When that rate rises, mortgage rates rise, corporate borrowing costs rise, and the cost of credit for households in every country shifts with it. The mortgage. The word comes from Old French and means dead pledge, because the pledge dies when the debt is repaid or when the borrower defaults and the lender seizes the property. Mortgages existed in ancient Rome and medieval England, but they were typically short-term instruments, 5 years or fewer, with large balloon payments due at the end. The 30-year fixed-rate mortgage was a New Deal invention. The Federal Housing Administration, created in 1934, standardized long-term amortizing home loans and insured lenders against default, making them willing to extend credit at lower rates. The same program, through maps drawn by the Homeowners Loan Corporation, designated Black and immigrant neighborhoods as high risk and ineligible for insured mortgages. These redline maps remained in use until 1968. The American home ownership rate rose from 44% in 1940 to 62% by 1960. That increase almost entirely bypassed Black Americans. The wealth gap between Black and white households today is, in substantial part, a mortgage access gap created between 1934 and 1968. Outstanding U.S. mortgage debt currently stands at over $12 trillion. Installment credit. Isaac Singer wanted to sell sewing machines, but his machines cost $108 in 1856, roughly $3,000 in today's terms, and most working families could not pay that at once. His solution was $5 down and $5 a month. Within a decade, Singer was the largest manufacturer of a single consumer product in the world, not because he built a better machine, but because he invented a payment structure that made it accessible. By 1919, General Motors had applied the same model to automobiles through its financing arm, the General Motors Acceptance Corporation. By 1927, roughly 75% of all durable goods sold in America, including radios, furniture, refrigerators, and pianos, were sold on installment. The installment structure is fixed: a specific purchase price, a specific number of payments, a fixed interest charge, a fixed end date. You pay it off. The debt has a bottom. You always know exactly what you owe and exactly when you will be done. The auto loan. GMAC pioneered it in 1919, and the auto loan has never lost the structural logic Singer established. Buy now, pay over time, pay interest on the unpaid balance. What has changed is the term length. In the 1980s, a typical auto loan ran 36 months. Today, 60-month terms are standard, 72-month terms are common, and 84-month terms exist for buyers who need to reduce the monthly payment enough to afford the vehicle at all. The longer the term, the more interest paid, and the more likely the borrower is to be underwater, meaning they owe more than the car is worth before the loan is repaid. Total outstanding U.S. auto loan debt reached $1.69 trillion in 2024. Unlike a mortgage, an auto loan builds no equity. Cars depreciate. A house bought with a mortgage typically appreciates over time, and the borrower's equity grows. A car bought with an 84-month auto loan loses value from the day it is driven off the lot, while the debt persists for 7 years. Subprime auto lenders who extend credit to borrowers with poor credit histories charge rates between 18 and 25% annually. 5. The credit card. Bank of America mailed 2 million unsolicited cards to residents of Fresno, California on September 18, 1958. The card was called Bank AmeriCard. It introduced revolving credit to ordinary consumers, spend up to a credit limit, pay any amount above the minimum each month, carry the rest as a balance that accrues interest, and borrow again. If you pay the full balance, you pay no interest. If you carry a balance, the interest compounds and the lender earns on money it never expected to see returned quickly. In 1978, the Supreme Court ruled that a bank could charge its home state's interest rate to customers anywhere in the country. In 1981, Citibank moved its credit card operations to South Dakota after that state eliminated its usury cap in exchange for 400 Citibank jobs. Delaware followed. Every state with a major bank followed. Interest rate caps that had existed in every American state disappeared within 3 years. A financial product designer named Andrew Carr subsequently lowered the standard minimum payment from 5% of the balance to 2%, roughly doubling how long it took most borrowers to pay off a balance and roughly doubling the interest collected. The average U.S. credit card rate in 2024 exceeded 22% annually. Total outstanding U.S. credit card debt exceeded $1 trillion. 1. The personal loan, the simplest institutional credit product for individuals. A bank gives you a fixed sum, you repay it in fixed monthly installments over a fixed period with interest. In most cases, no asset is pledged as collateral, which makes it riskier for the lender and more expensive for the borrower than a mortgage, but cheaper than a credit card. The Morris Plan Banks, founded in 1910 by Arthur Morris, specifically targeted working class borrowers who had been shut out of commercial banks and were relying on loan sharks. Morris charged 6% on the original loan balance, which worked out to roughly 11% on the declining balance, far below the alternatives available to poor borrowers at the time. Fintech lenders, including Lending Club, founded in 2006, and Sophie, founded in 2011, moved personal lending online and extended access to borrowers traditional banks declined. Outstanding U.S. personal loan debt reached $242 billion in 2024. The personal loan is the instrument that determines whether someone facing a financial emergency turns to a regulated bank or a payday lender. The difference in cost between the two can be several hundred percentage points. The student loan, the federal student loan program in the United States, was created by the National Defense Education Act of 1958, motivated not by educational philosophy, but by the Sputnik launch a year earlier and the fear that the Soviet Union was producing more scientists and engineers than America was. The design was modest, help students access college, let them repay over time. The design changed in 1998 when Congress removed the ability to discharge federal student loans in bankruptcy except under conditions of extreme hardship. Private student loans lost bankruptcy protection in 2005. This made the student loan unique in American consumer finance. A person who takes on $40,000 in medical debt can discharge it in bankruptcy. A person who takes on $40,000 in student debt cannot, regardless of what happens to their income, their health, or their career. The lender bears no default risk on federally backed loans because the government guarantees repayment. Outstanding U.S. student loan debt stands at $1.77 trillion held by 43 million borrowers. The Payday Loan. It is a short-term loan extended to someone without good credit due in full on their next payday. The standard rate, when annualized, runs between 300 and 400%. The problem it solves is real. Your car breaks down Tuesday, you get paid Friday, and you have no other access to cash. A lender gives you $300 on Tuesday and takes $345 on Friday. That $45 fee is 15% for 4 days. Across a full year, it is roughly 390%. The Consumer Financial Protection Bureau found that about 75% of all payday loan fee revenue comes from borrowers who roll over or reborrow within 2 weeks of paying off a previous loan. 59% take out more than one loan per year. The business model depends on customers who cannot pay it off cleanly. Before the 1980s, charging 400% interest on a private loan was illegal in most American states. The deregulation of that decade did not produce new financial innovation. It revived the oldest form of high-cost personal lending and gave it a storefront. Microfinance. In 1974, a Bangladeshi economics professor named Muhammad Yunus traveled to a village near his university during a famine. He met a woman who made bamboo stools. Each day she borrowed 22 cents from a local trader to buy materials, made the stool, sold it, repaid the trader, and kept about 2 cents. The trader set the terms because the trader had the capital. Yunus surveyed 42 women in the village in similar arrangements and found their combined debt totaled $27. He lent them the money himself. All 42 repaid. The bank he founded, Grameen Bank, eventually reached millions of borrowers with repayment rates above 95%. The principle he had identified: very poor people, especially women, repay small loans at high rates when their social standing is at stake. That same logic underlies rotating savings associations, which exist on every inhabited continent under different names. Tanda in Latin America, Susu in West Africa, Hui in China, Chit Fund in India. A group of people each contribute a fixed amount periodically. One member receives the full pool each cycle. No interest, no bank, no formal contract. The collateral is the group itself. When commercial microfinance lenders entered Andhra Pradesh, India, charging 40 to 60% annually with aggressive collection practices, the state government documented dozens of suicides by over-indebted borrowers and shut the industry down in 2010. Corporate credit. Corporations borrow money in two primary ways. The first is bonds. A company issues debt to investors and promises to pay interest at regular intervals and return the principal at a fixed future date. Rating agencies, including Moody's and Standard & Poor's, assess the credit worthiness of each issuer, and the rating determines the interest rate the company must pay. The second is commercial paper, short-term unsecured debt, typically maturing in fewer than 270 days. Used to fund day-to-day operations like payroll and inventory. Marcus Goldman began trading commercial paper in New York in 1869, financing merchants' short-term receivables. That business became Goldman Sachs. The U.S. corporate bond market holds over $10 trillion in outstanding debt. When corporate credit tightens, as it did in the fall of 2008, companies cannot refinance short-term obligations, cannot make payroll, and the freeze transmits directly into unemployment. This is why central banks intervened to backstop corporate credit markets in 2008 and again in 2020. Corporate credit is not a product consumers use directly. It is the mechanism that keeps the organizations they work for operational. Buy now, pay later. It is installment credit from 1856 reduced to a button on a screen. A retailer offers to split a purchase into 3 or 4 equal payments over a few weeks, typically with no interest if paid on time. In 2024, an estimated 360 million people globally use some form of it. The lender collects 2 to 8% of the transaction from the merchant rather than from the borrower. This is how the product is marketed as interest-free. The cost is built into the merchant fee, which is built into the price of the goods, paid by every customer whether they use the service or not. In most countries, buy now, pay later loans do not appear on credit reports. A person can carry 4 active obligations, each appearing small on its own, while no single lender can see the combined total. The credit reporting system, with all its failures, at least required lenders to look at the same picture of a borrower's debt before extending more. Buy now, pay later created a shadow layer of debt visible to no one. Regulators in the United Kingdom, Australia, and the United States have identified this as a systemic risk. As of 2026, none have resolved it. DeFi Lending. In 2018, a protocol called Compound Finance launched on the Ethereum blockchain. There was no bank, there was no loan officer, there was no credit check. A smart contract, which is a self-executing piece of code that runs automatically when conditions are met, held the collateral, calculated the interest rate, and liquidated positions if the collateral's value fell below a threshold. Borrowers posted crypto assets worth more than they wished to borrow, typically $150 in collateral to borrow $100, and received funds immediately. Lenders deposited crypto into shared pools and earned algorithmically set interest that adjusted in real time based on demand. Every credit dynamic that has existed since the Babylonian grain loan was preserved intact. Lenders earn, borrowers pay interest, collateral is liquidated on default. What was removed was the human intermediary. What was not removed was the fundamental constraint. The people with crypto assets to pledge as collateral could borrow. The people without them could not. DeFi protocols lost hundreds of millions of dollars to smart contract vulnerabilities in their first years. Total value locked in DeFi protocols peaked at roughly $180 billion in late 2021 before falling sharply. Whether blockchain-based credit solves any of the problems that credit has always created remains an open question.